NVIDIA just closed 2025 with some massive news that could shape its entire 2026. On the final trading day of the year, reports emerged that NVIDIA is reaching out to Taiwan Semiconductor to significantly increase production of its H200 AI chips. And the reason is shocking. Chinese technology companies have ordered more than 2 million H200 chips for 2026, but NVIDIA currently has only 700,000 units in stock. That's nearly 3 times the demand versus available supply. And this is happening while the stock sits at around $187 per share after delivering roughly 40% gains throughout 2025. The big question every investor is asking right now is simple. Should you buy, hold, or stay away from NVIDIA at these levels? Let's break down the numbers in the simplest way possible so you can make your own informed decision. NVIDIA is now one of the most valuable companies on planet Earth, with a market capitalization of $4.59 trillion. To put that in perspective, the company is worth more than the entire GDP of most countries, and it has achieved this by becoming the dominant supplier of AI chips that power everything from ChatGPT to self-driving cars to advanced medical research. The enterprise value sits at $4.53 trillion, which shows the market is pricing in not just current performance but decades of future growth in artificial intelligence infrastructure. The company has 24.3 billion shares outstanding, and importantly, management has been buying back shares with the share count decreasing by 1.13% over the past year, which is a positive signal that the company believes its own stock is undervalued. Now let's talk about whether NVIDIA is too expensive or actually reasonable at current prices. The trailing price-to-earnings ratio is 46.72, which sounds very high compared to the broader S&P 500 average of around 20. But here's the key detail. The forward PE ratio is just 26.98, meaning analysts expect earnings to grow so fast that the stock becomes much cheaper over the next 12 months. Even more important is the PEG ratio of 0.72, which measures price relative to growth. Any PEG ratio below 1 is considered attractive, so NVIDIA is actually trading at a discount to its growth rate despite the high headline PE multiple. The price-to-sales ratio is 24.46 on a trailing basis but drops to 14.87 forward, again showing that revenue growth is expected to accelerate dramatically. One of NVIDIA's biggest strengths is its balance sheet, which is absolutely rock solid. The company has $60.61 billion in cash and only $10.82 billion in debt, giving it a net cash position of nearly $50 billion. The debt-to-equity ratio is just 0.09, which is extremely low and means NVIDIA is barely using any leverage. The current ratio is 4.47. Meaning the company has more than $4 of liquid assets for every dollar of short-term obligations. So there is zero liquidity risk here. Interest coverage is an insane 445.84, meaning NVIDIA earns enough operating income to cover its interest expenses more than 400 times over. This is a company that could easily weather any economic storm or market downturn without breaking a sweat. NVIDIA's profitability metrics are genuinely world-class. Return on equity is 107.36%, which is absolutely extraordinary, and means the company is generating more than $1 of profit for every dollar of shareholder equity. Return on invested capital is 66.87%, and return on assets is 53.53%, all of which are elite-tier numbers that most companies could never dream of achieving. In the last 12 months, NVIDIA generated $187 billion in revenue and earned $99 billion in net profit, translating to a profit margin of 53%. Gross margin is 70%, operating margin is 58.84%, and free cash flow margin is 41.32%. These are software-like margins in a hardware business, and they show NVIDIA has massive pricing power because customers simply have no good alternatives for high-performance AI chips. NVIDIA generated $83 billion in operating cash flow over the last year and $77 billion in free cash flow after capital expenditures of just under $6 billion. Free cash flow per share is $3.18, and the company is returning capital to shareholders through both tiny dividends and share buybacks. The dividend is symbolic at just 4 cents per share annually with a yield of 0.02%. But the buyback yield is 1.13%, meaning the company is actively reducing share count and increasing your ownership percentage over time. The combination gives a shareholder yield of 1.15%, which is modest, but not the main reason you own NVIDIA. You own it for growth, not income. Here's where things get really interesting. NVIDIA just made contact with TSMC about ramping up H200 chip production because Chinese tech companies have placed orders for over 2 million units for 2026. But NVIDIA only has 700,000 chips available right now. That's a supply shortfall of nearly 1.3 million units, and it shows that demand for AI infrastructure in China is exploding despite ongoing trade tensions between the US and China. Chinese companies are racing to build AI capabilities before potential export restrictions tighten further, and NVIDIA is the only supplier that can deliver the performance they need. On top of that, NVIDIA just completed its largest acquisition ever, buying Groq for $20 billion in cash to integrate advanced AI inferencing technology into its platform. This deal, announced in the final days of 2025, is a game changer because it gives NVIDIA not just training chips, but also best-in-class inference chips, which are what run AI models in production after they've been trained. Wall Street is overwhelmingly bullish on NVIDIA right now. Out of 63 analysts covering the stock, 58 rate it as buy or strong buy, which is a 97% buy rating. The consensus price target is $252 per share, which represents 33.77% upside from current levels around $187. Analysts are forecasting revenue growth of 27.73% annually over the next 5 years and earnings per share growth of 28.46% per year, which would be absolutely spectacular for a company already generating nearly $200 billion in annual revenue. The stock has gained 37% over the past 52 weeks, but interestingly, it has been relatively flat since July, which some analysts believe creates a buying opportunity before the next leg up. No stock is without risks, and NVIDIA has several worth understanding. First, the stock has a beta of 2.28, which means it is more than twice as volatile as the overall market, so if you can't handle big swings, this may not be the right stock for you. Second, the valuation is still high by traditional standards, with a price-to-book ratio of 38 and a price-to-free cash flow ratio of 59, so if growth slows for any reason, the stock could see a sharp correction. Third, NVIDIA faces ongoing geopolitical risks, especially around US-China trade relations and potential export restrictions on advanced chips. Fourth, there are concerns in some circles about a potential AI infrastructure bubble, with some investors warning that data center spending could collapse if AI monetization disappoints. Finally, competition is coming from AMD, Intel, and even cloud hyperscalers like Amazon and Google who are designing their own AI chips, though NVIDIA still holds an estimated 80 to 90% market share in AI accelerators. So here's the simple framework to help you decide what to do. If you believe artificial intelligence will continue to grow massively over the next 5 to 10 years and that NVIDIA will remain the dominant supplier of AI chips, then the stock is reasonably priced at a forward PE of 27 and a PEG ratio of 0.72, especially with a rock-solid balance sheet, over 100% return on equity, and massive free cash flow generation. The China demand surge and the Groq acquisition are both catalysts that could drive the stock higher in 2026. On the other hand, if you think AI hype is overblown, that valuations are stretched, or that geopolitical risks could hurt NVIDIA's access to key markets, then you might want to wait for a better entry point or look elsewhere. NVIDIA closed 2025 with 40% gains, a $20 billion acquisition, and record demand from China for its newest chips. The fundamentals are strong, the growth story is intact, and Wall Street is almost unanimously bullish, with price targets 33% above current levels. But remember, past performance doesn't guarantee future results, and this stock moves fast in both directions. Do your own research, understand your risk tolerance, and never invest money you can't afford to lose. This video is purely educational and is not financial advice. Always consult a licensed professional before making any investment decisions.